Yan. So my name's Hui Lin, and as Yan mentioned, I work at the Access to Insurance Initiative. And what we are is a kind of, we are a training and knowledge provider, capacity building provider for insurance regulators, particularly in emerging markets. And our main mission is to help them increase access to insurance through regulations. And we have training, we have communities of practice, we have webinars and dialogues where we try and bring regulators together to discuss inclusion issues. I myself have been at A2I for about 4 years. My background before that was also very much regulatory. I was with the insurance regulator and the Central Bank of Malaysia, where I worked on inclusive insurance issues, financial sector development generally, sort of like liberalization, bank branching, always sort of from an access and inclusion perspective. So that's kind of where I suppose my roots are. And all that I've heard today is very new to me, but I guess in a sense that's good that we are trying to sort of bridge these perspectives together. And yeah, so today I'm here at some point to talk about insurance regulators, what insurance regulators do, and maybe sort of share some insights from my perspective on how regulators think. And maybe from there you can then also sort of, share your perspectives on how you feel decentralized insurance sort of fits into this sort of frame of thinking as well. So let's just start by putting insurance regulations in very practical terms, right? So what do insurance regulators do? So firstly, they seek to prevent harm, right? They want to make sure that claims are paid when somebody puts their money down for insurance. Secondly, they want to make sure that anybody who gets into an insurance transaction is treated fairly. So from the point of product development and pricing, to the point of sales and educating the consumer, to the point of servicing when the customer is lost and needs a bit of help with what to do with his or her documents, and to the point of claims. So they want to make sure that people are treated fairly throughout the insurance process. And thirdly, they also want to make sure that policyholders and consumers generally are aware of their rights and they know what to do to act on them. So who to call when they want to make a complaint, for example. So that's the first part. And the second part is that regulators also proactively want to shape outcomes for the insurance sector. So a lot of them also have a vision for what they want to see, how they want to see the insurance industry, right? So they want to see better products and services that can service a wide range of people. They want to see more inclusive access. And maybe they also want to see modernization and digitalization and efficiency. So, in essence, they are not opposed to things like blockchain, right? It's just maybe some other barriers that have to be overcome. So from a regulatory point of view, just to maybe share a little bit of how regulators see inclusive insurance. Maybe we talked a little bit early in the morning today about microinsurance, inclusive insurance, but basically from a regulatory point of view, it's about insurance that's accessed by people who are in the low-income population. But also in some other jurisdictions or some other countries, it's also about insurance products that are for people who don't have access to insurance for whatever reason. For example, cancer patients who can't get travel insurance. So it really depends on the country, but in any country you will always find a group of people who can't access insurance because, as you know, insurance penetration rates are very low. And right, so in a lot of emerging markets especially, what do the excluded look like? We also heard a lot of very interesting stories this morning already. So, it's really the 90% of people, or employed people in Ghana who are informally employed. It's the 80% of Moroccans who are unemployed, who are youths or 65 and older, what they call housewives, low-income households, farmers, micro-enterprises. It's the 90% of the poorest rural and urban Indians, so it's not about just rural people, rural and urban Indians with no health insurance and who have to use up their savings, who have to borrow from people, or who have to delay healthcare in order to have a better quality of life, right? And these are all target groups that were articulated by their own governments themselves. So this is how they see inclusive insurance. But now back to the regulatory business. How do regulators operationalize regulations? So going from left to right, I'm sure this is a diagram that most of you understand better than me, but going from left to right, so if you fall within the definition of insurance legally and from regulatory terms, then you are likely subject to a whole bunch of regulations. And you can see it's structured in a very certain way from regulatory point of view. So regulators see that, okay, if you want to be an insurer, you probably have to be subject to gatekeeping requirements. So how much capital you have to hold in order to even start running in the first place. What does your board of management look like? Do you have good people leading the different departments? So that's just even to set up the business, right? And then to continue your business, you have to have things like risk management policies. How do you assess your own risk? Which is why the presentation we heard from Adi and Antonio today are really interesting, because this idea of own risk assessment is something that regulators care a lot about. Things like claims policies and processes. How do you approach that? Do you have the right people assessing claims? Are there conflicts of interest? Okay, and then if you are an intermediary, and regulators grew up with a very traditional idea of intermediary. In most regulations, you'll find that intermediaries are defined as the people who sell insurance, brokers, agents, and so on. And usually regulators will have requirements like disclosure, advice, how you explain a product to a consumer, what kind of commissions and fees and how much can you receive from the insurer as an agent, what kind of qualifications and training you have to have. And as a consumer, of course, regulators don't technically regulate you, but there are requirements we heard about today, like KYC and AML. But as a consumer, regulators generally try to set up an ecosystem for you so you know where and how to act on your rights. So things like complaints hotlines, dispute resolution bodies, and information and education. So that's if you're an insurer, and that's a whole lot of things. I spent 1 minute talking about what kind of regulations an insurer would have to be subject to, right? So that's a lot. But if you're not an insurer, usually what regulators do is to assess whether you pose significant risk, and that means, whether you are likely to compromise some of these outcomes that I talked about, whether you are likely to be a scammer, or whether consumers are likely to think you're a scammer, and then, so if you're not an insurance company, regulators will consider these factors, assess if you pose significant risk, and then they might decide, okay, if you pose a lot of risk, they might subject you to intense monitoring. So asking you to report certain data every month or something like that, which is, of course, a huge compliance burden. They might, one quite popular thing that happens in the inclusive insurance market is this idea of formalization, where, for example, if you are cooperative, offerings of peer-to-peer risk protection, if regulators feel that maybe you're growing a bit too much, too fast, they might ask you to then apply for a license, and they might create a new licensing framework for you. So in that sense, there is some risk or considerations in growing big as well, right? And of course, if you are not an insurance company or you don't fall within the definition of insurance, so the last sort of branch of that diagram, regulators might subject you to some light monitoring. They might just say that, okay, as long as you don't call yourself insurance, I don't care what you do, just use some common sense, right? So this is kind of the frame of thinking of insurance regulators. Now, the difficulty is, of course, when there are gray areas. First, for example, people like Acre Africa and Pula, who bring so much value to the insurance market, but they don't fall neatly into these buckets, right? Insurer or intermediary. So how does the regulator deal with these things? So, I mean, different regulators have found different ways of trying to sort of retrofit new innovations into this structure. But generally, it's kind of these three approaches. So firstly, what they might do, as I mentioned earlier, they might come up with like a dedicated licensing framework for you. They might come up with a new product category for you, like microinsurance, or in Ghana recently, there was this new innovative insurance license that they created under the new insurance law. What that means in detail, nobody really knows yet. There's also regulatory sandboxes and piloting, so carving out sort of a safe space for new innovations before you transition into more formal licensing arrangements. And then there's just generally updating of regulations, so allowing new digital processes, allowing e-signatures. So the nice thing is that regulators are nowadays, they really recognize the value of being technology neutral, right? So they really understand that, okay, it's not really about the kind of technology you use, but to what outcomes and what activity you're doing. So that, to me, is at least a more sort of future-aligned way of thinking. So one interesting kind of topic in this area is the idea of index insurance as well. There was a whole lot of debates around whether parametric insurance is even insurance. And some regulators have actually just decided they're not insurance, they are derivative. And as far as they're concerned, they're not going to regulate it. So there are these sort of different nuances as well. But what then makes insurance insurance in the first place? Right, there are a few things that are sort of common characteristics. So usually there is sort of a description that says that there must be a sort of legal contract where one party is often obliged to confer benefit from one person to another when you have a fortuitous event. So an event beyond anyone's control, so there's no moral hazard. And usually it must involve some kind of payment of premiums or some kind of consideration from the policyholder. And finally, there should be some kind of insurable interest, which is why with parametric insurance, it was a little bit complicated. But of course, the explicitness of these requirements and how it's worded in every country, sometimes if we are in the US, every state can be quite different, and that's often the challenge. So I guess the question is also then, how does decentralized insurance fit into this framework? So the other interesting thing about regulators is that, especially when you're dealing with emerging market regulators and low-income segments, even when it's not officially insurance, they tend to be extra careful. So this is a quote from a paper by the International Association of Insurance Supervisors, and this was specifically about index and parametric insurance. So the idea that there's still a need to ensure that the insurance market is not undermined for any reason by a product that consumers perceive as insurance, but is not legally insurance. What this means is, as far as some regulators are concerned, if there are farmers being approached by anyone who says that, oh, you know, if you pay me something for this, when this happens, we'll give this to you. If anything that could be insurance-like, it might be sensitive for regulators, and this is what they mean by this statement. So the problem with grey areas, and I guess it's probably something that's a struggle that most of you really appreciate, is that it takes regulators time to respond, right? Because they have to do all this extra research, and honestly, a regulator is like any other organization. They don't have resources, they don't have people looking into new topics, and when a query comes into their email, they're like, oh no, what do we do with this? Let's check with our boss, let's check with our boss's boss, let's arrange a management meeting. And in a regulatory world, that really takes forever because they have a whole queue of things for management committee to discuss already, right? So it's a lot of research that needs to be done, a lot of indecision, internal or legislative processes. And also the issue is that regulators are conservative animals, right? So whenever there's something new, there's a risk that you will end up with extra cautious requirements. So I know one regulator where when they saw sort of a P2P insurer operating in the market, they immediately sent out an announcement to the public saying, this is not insurance. And it actually caused the company to lose some members because they thought that they perceived it as some kind of, fraud warning. So these things happen, and it's quite amusing. So, yeah, so I guess this is where I will leave you. And my question to you and to Jan is really, where does decentralized insurance fit in?
Exactly. Thank you very much for this very